And I'd like to welcome everybody that is here. Thank you for spending this hour with us. We are going to get started in just a moment. I think somebody else is joining us. There we go. But I want to introduce Peter, but first, on behalf of Savvy Ladies, I want to say thank you to Peter for spending this time with us and being a part of us as we get a little more savvy on credit. I'd like for everybody to post in the chat a word that comes to your mind when you think about credit. Is it scary? I saw we have someone saying empowering, great word. So go ahead and post that in the chat. And again, if you want to turn your camera on, we love to see your smiling faces, but if you could just keep yourself on mute so that we can hear everybody. And if you have any questions at any time, please feel free to post them in the chat. And at the end, we'll do some live Q&A as well. Looks like everybody's joining all of a sudden here. Well, without further ado, let's go ahead and get started with Peter. Again, Peter, thank you for being here. I'm just going to turn it over to you.
Okay. Well, thank you very much, Tracy, and thank you, everybody. Glad to be with you this afternoon. I'm in the great city of, or near the great city of Boston on the East Coast. So if I drop a couple R's here and there, try and, if you don't understand what I'm talking about, let me know. All right. So I'm here to talk about credit and basically a very important topic. My role here in this particular organization, it's a nonprofit called American Consumer Credit Counseling. We serve all 50 states. So just as an FYI, this isn't an infomercial. It's just simply saying, if you are in deep credit card debt, and by that I mean, 10 or 15,000 or more, you can always look us up, and we are we are national, as well as we have, we serve people in it. Since we're a nonprofit, our rates are extremely low, and we're very ethical and moral about what we do. So we can help you get out of debt in a reasonable period of time. Let me talk about today. I have my picture and also my email. So I do that on purpose, just so you know who I am. And if you take that down, following this webinar, following this seminar, if you ever want to contact me, feel free to do it. If you have questions on this topic today, feel free to contact me, email. And also, if anything comes up about any consumer financial issues, that's kind of the role we play. We're a nonprofit providing free financial literacy all over the US. So glad to be with you. And I hope that this adds you some good information today. Our goal for today, the purpose of our session, is to drill a little bit deeper into the whole question of credit. Some things are visible, some things are not. It's like the old iceberg. Some things are on the top that you see, but there's a lot of stuff underneath the water that you may not necessarily see. I always see my role as a credit counselor and coach and someone who does a lot of speaking on these kinds of topics, is to try to provide you with some ideas and some choices that it's not only just what you know, but it's what you do as a result. So hopefully you will see that there's some actions you can take to hopefully improve your scores, increase the good, decrease the negative. That's very basic, but that's kind of what it's about. And we want to find out what those things are. We'll talk a little bit about credit, some of the mechanics of it, but also that introduces the players. So that means who are some of the main agencies and players in this whole space. I'm a believer firmly that the more you know, one of those things, the more you know, the better you can control some of your own credit fate. And I'm a believer that that's hopefully what we're going to start on today. And if you ever do contact me, I could provide you more information too. So we are a source of info. Let's get on with this whole idea, and I'll break, like I said, periodically. And I'll invite you to either unmute or put a question in the chat if you have a burning question. Hopefully it's one that's more global in nature rather than specifically, my husband is a jerk and this is what he did. About, that's not what I want to hear. I want a good, nice, good credit question you're not clear on, that kind of thing. All right. So for users of credit, let's talk about this as a starting point. Credit is a very, very powerful tool, as you probably all know. And in the United States, it's highly used. There's nothing wrong with credit, And it's something that I would consider a privilege. And I think that's one way to look at it. It's a privilege, not a right. And so to have it be a privilege, it means you got to earn it. And so there's parts of the left-hand part here that we all got to be on board with. Credit is the ability, it comes in so many different forms, not just credit cards. It comes in the forms of loans, student loans, car loans, house loans, all kinds of ways that we are given something before we pay for it. So it's the only way that we can get through America in some cases, because with housing costing, you know, 500, 600, 700,000, very few of us have the cash in pocket to pay for that. So we pay for things. This is great. We borrow money, but there's a contract that goes with it. The contract is, yes, I'm sorry to say, if you borrow money, you do have to pay it back. Yep, sorry to blow that bubble for you, but you got to pay it back. You got to pay it back on time, and you usually have to pay it with interest. So those are the contractual obligations on us as borrowers. We're users of credit. And then what that does is, and this is kind of giving you the background, it builds up a reputation of you as a responsible user of credit. You use it, you pay it back, you use it, you pay it back, you use it, you pay it back, or maybe not so responsible. You use it, you sometimes pay back, you sometimes don't pay it at all, you sometimes let time go by. So the score, at least it attempts to be, is a measure of a prediction of your likelihood to pay or not. That's all a credit score is. It's imperfect, it's not scientific, it's just an effort. So we build a reputation as borrowers. So hopefully that's clear in your head. That's who we are, and that's what credit does. Let's move to the right-hand side and the providers of credit. There's many, right? Schools, businesses, nonprofits, credit card companies, mortgage companies, banks, credit unions, all kinds of folks that are lining up to lend us money. And what's the purpose? I mean, be clear on their purpose. Their purpose is to make money. They're not doing it because we're pretty or cute or they like me. It's because they want more money from me. And so that's their side of the equation, of which they are trying to protect their own risk. So they see all customers as either a risk or not. I'm rated a low risk if I pay back the money and I pay it back on time. I'm a low risk. If I'm someone who doesn't pay back on time and sometimes pays and sometimes doesn't, I'm a high risk, and eventually they won't lend me any money anymore. So hopefully that overview kind of sets us on this pathway to realize what our responsibility is as users of credit and what we can expect from those who lend us money. So I'm going to move on into some other topics, and I'll break. Like I said, I'm going to introduce some stuff and then break periodically to get your questions. When we think about the importance of credit in the United States, and again, I keep on saying that because the system is kind of unique. There's nothing like it in the rest of the world. And as a matter of fact, many people come from other countries and are having to be introduced to our system as kind of, I used to work with folks from call it Office of Refugees and Immigrants here within Boston. And this is one of the things I used to try to teach them. It's quite a challenge to kind of help everyone who's never seen this before understand our credit system, but we're still going to do the best we can. So what you need to know, if you don't know already, is that a credit score, for good or bad or for rightness or wrongness, I'm not judging it, I'm just saying it's often utilized to allow you to do other things or not. So therefore, sometimes when you try to rent an apartment, or you try to get utilities, a gas bill, or gas or electricity, or even a cell phone, many times those lenders, those businesses check our credit as a way of determining if they're going to even let us have these services or not. So credit extends beyond simply a interest rates or a credit card. It extends into other parts of our life, whether we like it or not. So hopefully that makes you focused, serious, doing everything you can, which I want to encourage, to get your score higher and decrease the negatives, increase the positives. So that's what I'll be talking about today. Let me tell you a story. Well, actually, let me do this. Let me start out by asking, are there any questions so far? Questions, comments so far? Either unmute or put it in the chat, and then my friend Tracy will read me a question or two, and we'll move on. Anything that's on.
Hi, this is Georgette. I have a question about what would be considered a high credit score?
You're muted.
Okay. Can you hear me?
Peter, you're muted. There we go. Okay.
There we go. All right. So your question is a good question, Georgette, and I would just say that is something we're going to cover in a little bit. I'll just tell you this in general now. We'll get to the details a little bit later. The scores range from a low of 300 to a high of 850. If you want to consider it like a grade score, like in school, like I'm about to show you in the next section, having an A in school, which you recognize, right, is very much have score in the high 700s to 800s. Having a B is probably more in the low 700s to high 600s. Having a C is probably mid 600s and down, and then so on. D, as you're getting a low 600s, you're D, and as you get below that in the 500s below, you're like an F. So if that makes sense from a grading point of view, that's kind of what I'm saying. So obviously, the higher your score toward 850, the better.
Thank you.
Other questions before I go on? All right, well, let's go into what I call the credit story. So the credit story is once upon a time. No, I'm not going to go that story. I'm going to say we all know what it's like to go in school. And I just alluded to school. So I like to always try to do a metaphor or kind of an analogy if we can. We all theoretically and hopefully can relate to school. We've all been there. So what happens in schools, you all fondly remember, is that you do all the work you do, you participate in school, you do the leaf report you were supposed to do, you fill out the book report on Tom Sawyer, you do all the things you're supposed to do, and you get a report card. In the credit world, we do what we do, and we get a credit report. It's supposed to be, it's not 100% of everything we do, but it's a lot of what we do. Gets recorded on a credit report. Now, we don't have any choice. It's not our choice. It's not our choice, not your choice, what goes there or not. It's put there by other agencies we're going to talk about in a second. So basically, it's largely, not perfectly, a reflection of what you do in the credit world. That's what it's intended to be. And I'll explain what's on it and what's not. Down below, to Georgette's question, so here's my first cut at it, you'll see that the credit report's different than a report card. A report card is from a teacher who saw you all year long and then grades you. There's a separate agency that does the grading here. And those other agencies are called FICO and Vantage. So they look at reports and determine, well, what grade is that? Is that a 700? Is that a 600? Is that an 800? That's what FICO and Vantage do. And they're using all kinds of funky math and all kinds of algorithms to figure this whole thing out. But it's based on evaluating every piece of action that you do. So when you get a credit report, which I highly encourage, and I'm going to encourage you throughout this session, this workshop, to get your own report. It's free. It doesn't hurt you. Get your own report. It's free. It doesn't hurt you. Did I say it was free? It is. So here's what's on it for the most part. And again, I'll go through this and I'll pause again to make sure that you're with me on all this. The report largely reflects 7 years of activity on you. So therefore, today is now February 15th, 23. For the most part, it goes back to February 15th of 16. So everything you've done backwards, and you want to think of it that way. Think from today backwards. Because the biggest influence you have on things that can help you are the things that are most recent. So therefore, things that this is February, so things you did in January or should have done in January or should have done in December, November, October, backwards. That's the biggest impact. But it reflects 7 years worth of today backwards. And then it tries to show you. So what's on there? These are the kinds of things: student loans, credit cards, auto loans, taxes. So it has both public records like taxes, child support. It also has a lot of business activity, like if you borrowed from, you had a credit card at Lowe's, or did you have a car loan through Chevrolet? Did you have a mortgage through Bank of America? Did you have, did you pay things off on time? That's what it's reflecting. So your report is made up of the bulk of this. Now, just make a note. This is not every single thing you do in the financial world. There's other things that I'm going to get to that aren't on the report. So recognize something like 80%, 90% of what you do, 80%, I'm guessing, is on this report. But there's other things you do in life that don't show up here. How does this work? You do the activities and they get reported. You don't report them. The ones who you borrowed the money from report you. It's like remember back when you're back in school, remember that time you hit that kid and they reported you and you had to go to the principal's office? Well, it's the same thing here. This is you getting reported by these creditors on what you did. Did you borrow? Did you pay back? You borrowed some money. You went to a school. You got a loan. Did you pay it back? And so who are they reported to? They're reported to these three bureaus. These three bureaus, Equifax, TransUnion, and Experian, are the collectors of all of this activity, and they're the ones who make the report. So that's somewhat the circle of life here, a little borrowing from Disney here, the cycle of life here, that we do things, it gets sent along, it gets moved through these bureaus, and then they create a report. The report's out there, sits there, and by separate agencies, they go and grade it and tell you, hey, your score is 714. That's the kind of way it goes. So one more piece of the puzzle to add, and then I'll open up to questions on this connection and these parties. The last piece that you may or may not know of, but this is kind of good for you to know, is that there's things on this sheet that I just showed up now, this yellow sheet to the left, that today often do not show up on your credit report unless you don't pay them. Now think of that for a second. It means some things that you do, like for instance, pay your utilities. That's an example. If you're in an apartment or you're in a house, you pay your gas, you pay electric, you pay your gas, you pay your electric, you pay your gas, you pay your electric. Then one day you don't pay it. What is it that shows on the report? The one time you didn't pay it. So therefore, there's some cases where negatives will show and all the other non-credit activity does not show. So that's an important note to self, that sometimes credit reports capture the negative and not the positive. Now, here's where something's changing for the good. Rent. If you all are in apartments today, you pay rent every month. And they keep record of it every month. Did you pay on time? Did you pay? Did you pay on time? Up until recently, that never went on your credit report because that's not considered credit. If you think about it, you're paying a landlord. It's not credit. But it is something about your credit. It is something about your payment habits. It does say something about you as a reliable payer. So that's why I'm saying that the credit report has morphed a little bit. It's changed a little bit to try to include other things that prove if you are a reliable payer or not. So this is actually a good thing. If you've been paying your rent for the last 10 years, that means you have 120 payments paying on time. So there are companies out there like Rent Reporters, Experian Boost, other kinds of things that are starting to be reported to the credit agencies and show your credit reputation. Okay, so I've just given you a lot of information about where the report comes from, how the info gets passed to it, what does show up and what doesn't show up. So an example, what doesn't: cash. You pay cash, you pay a debit card. That's you hitting your checking account. That doesn't show up. Those things don't. You pay your auto insurance. That doesn't show up unless you miss it. So I've said enough for this moment, giving you a lot to chew on. So Tracy, anything either in the
Somehow you're muted again. I don't know. I don't know what's going on. This is the strangest thing. Oh, you're still muted. There you are. Well, we do have a question while you're unmuting yourself. Let's see.
there I go.
There we go. Okay, so we have a couple questions. One question is, does the child support impact the receiver positively or just the payer?
Does the child support, meaning paying child support? Is that what they're saying? Paying child support?
Let's see. Tanya, do you want to unmute yourself and clarify that?
Well, I could probably answer it just in time, and they can still answer if they're not correct. The only thing credit reports show is those who are paying it, not receiving it. This is all about people's record of paying. So if you receive child support, that's not on a credit report. It would be incumbent upon whoever it is that has to pay these items. That's what's being kept a record of. So it's when you don't pay something you owe, that's when something goes negative. If you don't pay your taxes, that shows up as a negative. If you don't pay child support and you owe it, that's a negative.
Okay.
Other questions?
All right. It looks like, I don't know if we're going to get to this one, but are medical bills counted?
Very, very good question and very timely, as a matter of fact. The answer is medical bills are changing as we speak. They used to be just as prominent as every other bill. What's happened starting now in 23, as a matter of fact, so this is new, medical bills are smaller in their impact. And as a matter of fact, if you owe a bill over $500, normally the way most bills work is they go late. It's called delinquent after 30 days. They go into what's called default after 180 days. Well, here's what's new. If you have a medical bill over 500, it won't go delinquent until a year. So they're allowing more time for you to pay your medical bills before they show on your credit report. So the answer is you still owe it. It's just that they're giving you more time to pay it. I hope that answers your question. Other questions? We'll move on.
Did someone just unmute? If you unmuted, you can ask your question.
Okay, we'll take one more and move on.
There's still some in the chat. I think you're probably going to get to the.
Can you hear me?
Oh, yes, go ahead.
Hello?
Go ahead.
I have some small credit bills that have like annual fees on, like $300 credit cards that have like annual fees on them. And
Yep.
I wanted to close them down, but I was told not to close them down because that can impact my credit. But can I roll them over into like a 0% card?
Okay. So Deborah, you're asking some good questions again that will take a couple minutes to try and answer. So let me just answer it kind of quickly if I can. Number one, if anyone has cards in which there's a fee involved, first of all, I was just going to say as a financial coach and counselor, try to get away from them. There's so many cards that are out there. There's no reason anymore that you can't get rid of those cards and get one without a fee. So that's one thing. That's number one. Number two, the old myth that you should not get rid of credit cards or keep your credit cards at a zero balance. There's nothing wrong with keeping them at a zero balance. But here's what happens if you close credit cards. So let me try and give you all example just with some numbers. If I have 2 credit cards, and I'm making up a quick illustration, and the limit of each one is $1,000 for credit card A and $1,000 for credit card B, my full limit is $2,000, right? That's the availability to borrow. One of the important features of credit is to know how much of that $2,000 have I used. So let's use this scenario to illustrate. If I use $500 across those 2 credit cards, I'm using $500 over $2,000. If you remember your fractions from grade school, you know that I'm using 25%, 500 over 2,000, right? Everyone with me so far? You want your limit usage to be less than 30%. So far, so good. But if I close credit card B, my limit now just went from 2,000 down to 1,000. So as your limit shrinks, your usage proportionally goes up, right?
Mhm.
I'm hoping I'm not losing you with the math. I'm just saying, if you close down a credit card with 1,000 limit, my full limit that's left over is 500 used over 1,000. I'm now using 50% of my available limit. So the way that credit card closing hurts anybody is to decrease your limit and make your usage look bigger. So here's how you offset it. Number one, don't have a credit card that has a fee. Get rid of it. Open up a different credit card without a fee, because having that limit is a good thing. Use that card every now and then throughout the year so they don't close it. Okay, so then the third question I'm going to address is this. You asked about moving your credit cards over to a zero balance. Again, I can only say to you, everybody has to judge whether that's a good thing or not, because the credit card companies know that people do this, and they charge you anywhere from something like 3 to 5% of your existing balance for you to make that move. So what does that mean? If I have
More money.
$1,000 in credit card debt that I want to move to a zero, they're going to charge me anywhere from $30 to $50 to make the move. If paying $50 is worth it to you, then by all means, that might be good. But if you have a $10,000 balance and you move to a zero, you're going to pay $300 to $500 just for the right to transfer. So those are decisions you have to do the math on and figure out. I'm going to move on in the interest of time. A lot to cover, but good questions. So let me now cover the credit scores themselves. And again, I'm doing the best I can with 1 hour's time. Tracy wouldn't let me speak for 10 hours, so I only can speak for 1. So therefore, I'll do the best I can. All right, here's our happy faces we got here. As you see, more to the left, we're happier, we're in the green. More to the middle, we're yellow or average, and more to the left, we are orange or we are red, sad and red. You want to be more on the right-hand side. How do I get into the right-hand side? How do I stay into the right-hand side? Meaning my scores are higher. These are the kinds of activities you want to take note of. And by the way, I'll make this presentation available to Tracy if she wants to give it back out to you. And I'm sure for a very small fee, she'll let you have it. No, it's probably for free. So here's what you want to do. So these are the notes. Some of them I've already said. How do I keep my scores high? Make your debt payments on time, every month. That's it. That's the number one way to do it. There's no other secret. And even better, automate it. What does that mean? It means automatically, if I have a Visa bill that comes due on the 15th of each month, every month, I can set my bills up with a bank or with my work to have it say that it pays on the 10th, automatically pay something like $100 over to Visa. You figure it out, but you can automate it so you don't have to touch it. And paying more than the minimum is what is advised. So that's the number 2 here. Pay more than the minimum if you can. If you pay just the minimums, yeah, that's the good thing. You paid the minimum, great. But even better, pay more, because the amount of debt you carry, like I just said in the equation earlier, makes a difference. So you're trying to do multiple things here. You're trying to pay on time, but you're also trying to keep your debt balances low. So in my example I had before, if you have 2 credit cards and both have $1,000 limit, you have the ability to borrow $2,000. Is it wise for you to borrow all $2,000 that you are able to borrow? No, that's what's called maxing out your credit cards, and you're maxing them out, paying a lot of interest, and your credit score is going to go down. So here's the challenge for us Americans. They like to give us the availability to borrow, but we really shouldn't take advantage of the ability to borrow. We should show restraint. That's what they are looking for. So the third thing here is responsibly churn and pay credit activity. What I mean by that is, anytime you have a credit card that has a 0 balance, if you don't use it after a year, what happens? The creditor closes it. And that's not good. That wrecks your limit. Your limit goes away. And another thing I'll point out later, it gets rid of an older card. You want old cards with 0 balances. So how do I do that? Use the card a little bit, pay it off. Use the card a little bit, pay it off. Use it 4 or 5 times in a year, pay it off. That's how you churn and keep the card alive and well. If you just let it sit there, it doesn't help you. If I have a credit card with a $10,000 limit and I haven't used it for 4 years, that doesn't do me any good. They're going to close that card and I lose it. It's the fact that you use it a little and pay it. That's me proving my responsibility. What else? So you welcome higher credit card limits. If you have discipline, you know yourself, I don't know you, but if you have a $10,000 limit today, are you going to go out and buy yourself something for $9,000? That's up to you. I just would suggest you don't. Try to keep it below 30% usage. That's how you make this, you stay in the green. Keep your usage ratio limit low. That's what I just talked about. So whatever your limit is the bottom number. If it's 1,000 or 5,000 or 10,000, keep the amount that you actually borrow, this is a ratio, less than 30% of the number below. So make it 30%, 20%, 10%, 0%. And that's what you do is you pay your cards off each month. There's nothing wrong with that. Not only that, you don't ever pay interest. If you are on top of your cards and you do in fact use it throughout the month and then pay it off before the next payment period, you do a threefer. You use the credit card's money during the month. You don't pay any interest because you didn't go over the month end. And number 3, you show credit points by using it effectively. So that's the best case scenario if you're able to do it. And so then you keep an old card alive. That's what I said. If you have a card from 2015, one you got when you were younger, and I'm making this up. I had one when I was 18. My father bought me a Sears card. Now Sears doesn't even exist anymore. But I didn't even know I was doing something good by getting credit at an early age and using it just responsibly to buy some paint and some tools here and there and so on. So using credit for a long period of time responsibly is a win-win. So all these things together raise your scores. Let's talk about what decreases your scores, and then I'll go again to questions and comments. What decreases my scores? What keeps me in the orange and in the red? Number 1, here's some. Here's how, if you want a low score, this is what you need to do. Pay your regular payments. Make things late, 30, 60, 90, 120 days late. That's how you are going to decrease your scores. Allow your debt to keep growing. Don't pay it down, just let it keep growing. And if your debt ratio goes up, it's going to make your score go down. They're like a seesaw. One goes up, one goes down. Allow debts to go unpaid. If you're looking to get a low score, don't pay what you owe. It's that simple. I had one woman, I'll just tell you a quick story. I'm just saying, I deal with all kinds of clients. For some reason, she woke up one day and said to herself, I don't feel like paying my mortgage anymore. What she said. And she stopped. Now that may be her choice to do that. But let me tell you that the banks and the credit unions and the credit companies had a different idea as to what that meant. She may not have wanted to do it, but she's going to get penalized for that choice. That's life. What else can you do to bring your score down? And obviously, I'm not encouraging you to do these. I'm encouraging you to do the opposite. You allow some charge-offs. What's a charge-off? A charge-off is when you, in fact, allow something to go so old. Remember, I said you take care of the current first. What's happened in the last year or so, 1 or 2 years? Keep that alive, keep it moving, pay your bills. But as something gets unpaid and it gets to be 2 years old, 3 years old, eventually the creditors give up and they write it off their books. When they say, I can't collect from this person anymore, they do a charge off. So on your credit report, it says charge off, which means they don't expect payment. Now, if you pay them, you can still do it, but they may or may not take it off your report. This is one of the realities of credit reports. It's harder to get rid of old things that are accurate. If you didn't pay a bill 3 years ago, you didn't pay a bill 3 years ago. There's not a lot you can do today to change the fact that 3 years ago, you didn't pay a bill. You can try to pay the creditor. You can ask them if they'll accept the money today, but they're not demanded to take something off of your report that's a historical fact. You can negotiate with them, you can ask them to do it, and some will, some won't. So that's what I'm saying. It's hard to get rid of old, accurate things. It's easier for you to deal with current, alive things. Don't ever borrow over your limits. If your limit is 1,000, don't borrow 1,100. Even one time. If you go over your limit, that's marked on the record, over limit. And they record that forever. It's recorded for 7 years. Your limit was 1,000, and there it is. Over the limit, 1,100, it's kept for the remaining 7 years. And if you do declare bankruptcy, which again, I'm not advocating for or against, it's when you fully try to get rid of all your debts. That's one strategy you can do. It gets rid of your debts, but then it keeps a black mark on your credit report for up to 7 or 10 years, depends on which one you do. So I can have this negative, Peter got rid of all his bills, great. I got rid of all my debt, great. But now I have a bankruptcy sitting here that when I try to borrow next time, they're going to take note of that. Because what did I say at the very beginning of this session? What do the creditors want? What do the creditors want? They want money. If they know that I'm the one who's going to declare bankruptcy and run, why would they lend to me? If I'm not going to pay them back, why would they lend to me? If I'm not going to pay on time, why would they lend to me? You just got to ask yourself that question. So let me, and then so you see on this side then, on the left-hand side then, decrease in scores is these activities. So let me, again, go to the questions, go to the chat, ask Tracy not to mute me this time, and see if I can answer some questions.
Alrighty then, I think we're safe. Okay,
Excellent.
it looks like we might have answered some of these questions. There's
Okay.
a lot of questions in here.
Okay.
I think we answered, can having too many credit cards opening/closing hurt your credit score?
And we didn't really cover that, but the answer is yes. If you keep opening new ones, that's a negative. We'll get to that next.
Okay.
Okay.
I know having your credit check negatively impacts your score temporarily. What
Nope.
sort of scenarios would you expect your credit to be checked?
No, actually, let me address that now because that's one of those myths. And let's be clear on what the person's asking and what the way the life is. Contrary to what you see on commercials, contrary to what you see in ads, you all have the right and the legal right to check your credit as often as you want. You can look at your reports, you can order your reports, they can be ordered weekly. I'm going to cover that in a moment. But the looking at your reports does not hurt you. What hurts you? When you apply for credit. That's the difference. So if you go into a store, point of sale, I'm sure you've all seen this, right? You're at the Walmart, you're at the local, whatever it might be, the hardware store, and they say, hey, would you like to save 20% today? Get our credit card. And as soon as you sign, yes, I want one, you've just applied for credit. And even if you get rejected, right? They don't like me, I failed, I applied. So if you have more than 2 applications in 1 year, that's what's called hard inquiries. You don't want more than 2 hard inquiries in 1 year. Soft inquiries, it's hard to say the word, when you look at your credit, that's soft. I'm a credit counselor. You can ask me to look at your credit for you. That's free and it doesn't hurt you. Looking at your credit is a right. It's not something you're penalized for. So please get that straight. Other questions, comments?
Does the amount of income impact your credit score?
No, your amount of income has nothing to do with your credit score. So that's actually a very good question. Your amount of income is only going to be relevant probably when you first go to take out a credit card. Whether you get accepted or rejected for credit, they will check your credit, your limit. the amount of money you're making. How much money do you make per month? Because what they're judging is, brought back to the number one, can you pay us back or not? They're not going to give you a credit card if you make no money. They're not going to give you a credit card if you already are leveraged with mortgage debt and student loan debt and other kinds of debt, car debt, and you only have $50 left over each month. They're not going to probably give you a credit card because you're already maxed out on many other things. So your wages, what you make, is only relevant on the very first part of this, if you get a credit card or not. But your credit score has nothing to do with that. It's how did I pay or not? That's the key.
Right. Looks like we had just a quick inquiry about which credit cards don't have fees, and there's all kinds of places you can look online to compare the benefits of one credit card to another.
Yes.
And then the final question here is, can you explain how bankruptcy impacts credit scores and for how long? Does having a partner who's declared impact you?
Okay, so a couple questions. And then number one, there's 2 kinds of bankruptcy. There's what's called a Chapter 13 bankruptcy, is when you are still making some amount of money. You still have a job, you're making some amount of money. And a judge, it all goes back to a judge in a court, declares you are no longer responsible for 100% of your debt. You might be responsible for 25% of your debt. So since you're still making money, they use part of your money to pay off, let's just say 25 cents on the dollar to each of your creditors. So that's what's called a Chapter 13 or a working man's bankruptcy. A Chapter 7 is when you declare full bankruptcy. Again, it's only the judge that decides this. You can go to a judge, you can go to a lawyer, but it's the judge that decides whether you are eligible for Chapter 7. And what that does is wipes out all your debts. And that means all your creditors get nothing from you. So you start over again. You can declare bankruptcy every 8 years if you want to. I'm not encouraging it. I'm just saying you can. But what it does is leaves a black mark on your record for 10. So that bankruptcy will sit there as, hey, bankruptcy, and there it is. And then when you try to get further credit, because you're starting over again, it'll be hard for you to do so.
All right. And then the second part of that was, does having a partner who's declared impact you?
Oh, okay. Good question. And here's again, just to be clear, everyone's credit reports and scores are separate. So whether it's your partner, you're married to them, it has nothing to do with you're living together, you like each other, you hang around together, you have a beer. That has nothing to do with it. It's your credit is your credit. My credit is my credit. Here's the only difference. If I share a credit card with my wife, we both have access and authorization to the same Visa card. If that Visa card helps us, it helps both of us on our separate reports. If that Visa card never gets paid and we both are authorized users, it hurts both of us on our separate reports. If my wife, in her wisdom, decides to declare bankruptcy and what she's doing, that has nothing to do with me. That's her problem. I hope she doesn't do that. Okay, I'm going to go on in the interest of time. More questions will come up. I'm going to skip this for now because I'm not going to cover that. So let's talk about the report now. And again, I want you to take note down the bottom. This is one of those things I told you was coming. Annualcreditreport.com. Believe me, please write it down. You can get this thing after we're done, but if you want to, write it down and check it out yourself. The three credit bureaus by law have to post your report and make it available via this website to you. Now, it's a little funky. You have to answer some questions. It's all free, doesn't hurt you, and you can run them once a week. So this is what's new and kind of cool. Up until COVID, now COVID doesn't have many advantages, but this is one advantage of COVID. Since COVID came, before COVID, you could only order these once a year, hence the word annual. But because of COVID, they're available weekly. So that means that you can go to all three and order them on a Monday and then see how you're doing, make some changes, do some things, make some improvements, and order them a week later or a month later. My recommendation is to do it once a month. You don't need to have it weekly, but monthly keeps you in touch with how your credit is moving. It records everything. And you'll find that all three of those reports are not exactly equal. This is not a perfect system. So get that kind of in your thinking. These are not perfect. They are run by humans and by computers, and there's often errors. So what happens? All the activity that you do that I've talked about, not all, most, gets brought in by these bureaus and then gets stuck in your report. Your report is made up of 5 sections. No matter which one it's from, this is the 5 pieces that each one generally has. The first thing is all about you. Who you are, where you live, where you used to live, date of birth, what you're currently working at, and that should be true. It's not a super big deal, but this is one of those things that you want to have to be accurate. Because I don't want, you know my name, Peter Mullen, right? When I grew up, where I grew up as a kid, there was 2 Peter Mullens. It's hard for me to believe that, but there were 2 in my same city. We always got dentist appointments all screwed up. So there's no question that they can screw up your credit report too, right? You want only your stuff on your report. So check that for accuracy. Number 2, the other part that's in the middle of usually the first page, and it's a little different, depends on which report you're ordering. I like TransUnion myself. I find it to be the most easy to interpret, but you run what you want. I say run all 3 so you learn. It should summarize in the middle the 4 top reasons why your score is what it is. Now, sometimes it's not easy to interpret. It's not like it's very simple English, but usually you can think about it. The top reasons your score might be down is things like too many delinquencies. And if you remember, I defined delinquency earlier. A delinquency is anything that's past 30 days past due. So they keep record of that. Every single thing on your report is ticked. 30 days, 60 days, 90 days, 120 days late, or never paid, 180 days late. That's what's called default. So if it says things like too many charge-offs, too many defaults, too many delinquencies, you know what it is you're facing. And you'll see that where? You'll see that then in the account information. The account information is every single line. They call them trades. This is the terminology they use. They call it trade lines. So when you have a Visa card, a Walmart card, a Home Depot card, they will say you have 3 trades. That's the way they'll say it. So up in the top in the summary, you'll say you have 3 trade lines. Now, when you go down and look at the detail, There's Walmart. It tells you about your account, when it was opened, if it's still alive or closed. It tells you everything about you. Did you pay on time? There's all kinds of codes that tell you how have you been paying on your Walmart card. If you pay it every single month, right along, the way that the TransUnion does it is they put a little 1 in a box. So if you see, and it goes for 12 months, right? So if you see 12 months from January through December, what does that mean? It means you paid on time all that time. Again, you get used to these codes, but you don't have to look there. Just look on the summary page. If the summary page says no delinquencies, you've paid everything on time. If it does say delinquencies, and you go back and look at your Walmart card space, you'll see 2s and 3s and 4s and 5s. What does that mean? A 2 means 30 days late. A 3 means 60 days late. A 4 means 90 days late. So again, you get used to the codes over time. But the important thing is keep track of it, see that it's accurate, and start to do what you can to keep it current. It's hard for you to do things that happened, fix things from 4 years ago, but you can fix something from 4 months ago. The next section is public records. Again, this is often for most people has nothing in it. It's just some things that may show up if in case you have, tax liens or bankruptcies. Those are rare and you may not have them. The last thing is inquiries. So I already brought this up to you before. Inquiries is your record of how many times you look at your report. That's soft. You can have 100 a day and not worry about it. How many times did you apply for credit? That's hard. And every time you apply for credit, that's taken down and recorded on your credit report. Questions on this before I move on into the final kind of decipherization, if that's even a word, the deciphering of this report. I'll take one more question now, and then because we have only about 7 minutes left. One more question.
This is Georgette. A question about the part about the inquiring.
Yep.
Why are you penalized for inquiring about opening a card? I'm not clear on that.
Yeah, it's not the asking about. It's when you actually open a card. And the reason why that you get penalized is because you're spreading yourself too thin. So think of it this way. If I have, just pretend this as an example, I have a credit card now in Lowe's. I go and open up another credit card for Home Depot. I go on next week and open up another card for Walmart. I go a month from now and open up another card for Visa. Another few weeks, I open up another credit card for something else. It means I'm being spread too thin.
Gotcha.
What do those creditors care about? Each one doesn't care about the others. Each one wants their money. Walmart wants its money. Visa wants its money. Home Depot wants its money.
Right.
So therefore, overall, I'm spreading myself too thin. And so I'm a higher risk.
So let me ask you, even if you have a high credit score, if you're like an 850 that you're able to pay those off, it would still go against you?
Again, put it in perspective, Georgette. In terms of the numbers, it's a small hit. In the terms of the overall things you got to worry about, opening credit cards is not your biggest problem. That's one of the smaller problems. The biggest problem, and I'm just going to cover this next, so you're leading me right into this. I'll talk about what is the biggest impact. So we'll cover your very question and show that right here. The biggest portion of what you should be worrying about is your payment history. 35% of what you do is your history. What have I done? Did I pay? Did I not pay? That's the biggest piece of this equation here. So get it in perspective. Looking at your credit or asking for credit is, you can see it up at the top where it says new credit, 10%. That 10% is the max that opening credit cards could hurt you. So it's a smaller piece of the pie. The bigger pieces of the pie is 35% on what you do. Do I pay on time? Do I pay my credit or not? Number 2, the second piece is how much do I owe? So again, Georgette's bringing up a very good question, but it's what you see advertised all the time. And let me kind of explain one thing. Think for a second. Think who's kind of running a lot of the show and these commercials and all this other stuff. Do creditors really want you to stop using their credit cards? Don't you think it's in the credit card's interest to have you pay and max out your credit? Don't you think it's in the credit card's interest to have you keep a balance and pay interest on it all the time? Of course it is. So they're not the ones encouraging you to keep your credit low or to do these things. They want you to be in a position to continue to pay them on their credit cards. So you have to watch out for yourself, not Visa. They are in fact making trillions of dollars a day on us. The average credit interest rate in the United States is 20%. And if you do the math, something like, just do some quick math, something like $1 trillion moves every day. Multiply $1 trillion times 20%, and you'll see how much money the credit cards make on a daily basis. So that's an aside. What else is important here then? What you do is important, keeping your balances below 30%. The third thing I already mentioned, length of credit. So it's in your interest to keep an old credit card alive and well. Like I said, keep it on life support. If you have an old credit card from 2015 from Macy's, and you hardly ever shop at Macy's anymore, and it's old, it's 2015, it's 2010, I would suggest you go to Macy's once or twice a year and use it. Why? Because then the Macy's card stays on your record as an old used card. If you never use your Macy's card again, the Macy's company will close your card and your old card just went away. So it's part of knowing the game, playing the game, that part of your credit evaluation. I'm not saying I agree with the rules. These are the rules. I don't agree with it, but it is what it is. That age matters. So let's go to the last two. Last two is the types of credit in use. The yellow, 10%, simply means they like you to have credit cards and installment credit. So in an ideal world, you have a car loan, maybe a student loan, and then maybe you have 1 or 2 credit cards. 1 or 2 credit cards are unsecured credit. The other 2 are called installment credit. So ideally, you have a little variety. And the last 10% here is new credit. You don't continue to ask for new credit cards. That lowers you. We're running out of time here, so I'm going to try and jump to one last important thing to hit you with and leave us with this, because I want to leave you with a positive note. And that is this. If any of you have poor credit, no credit, low credit, are struggling with credit, another way you can bolster it is you don't have to get credit cards to prove that you're credit worthy. Here's 3 other methods. And again, in the absence of time, you'll see, I'm just going to tell you, I'm telling you where you can go find them, so you don't have to write this down. But I will tell you what they are very quickly. A credit builder loan is a method by which you go to your local bank or credit union and you say to them, if they offer it, not everyone does, but you ask, do you offer this? And what are your rates? You basically work with them to build up to a loan. So how does that work? You basically say to them something like, I'd like to save up to $1,000. I'm going to pay myself $100 in your bank for the next 10 months. So think of that. You're paying yourself on time for money for yourself, and you're getting credit for it. It's a wonderful thing. You get the money at the end. It's like forced savings. The only thing is, of course, you do have a fee taken out. So what you get from Bank A versus Bank B versus Bank C may differ on the fee. You have to find that out. The second thing, which you've probably all heard of, is secured credit card. Now, the way that works is you put an amount of money in the bank to start. 200 is the minimum. So you put in 300, 500, and they issue you a credit card on training wheels. That basically is a credit card that's backed by your money, and you get to use the credit card like a credit card. Use it, pay it. Use it, pay it. Use it, pay it. And the record of you using it responsibly and paying on time, eventually they do what they call graduate your card. They give you your money back. If I paid $300 for that card, they graduate your card as a value of $600. And then the money is still my money. So it's like a win-win situation again. But the whole point of both of those is what? Is you proving yourself throughout that time period. If you don't pay yourself like you should, you're hurting your own self. And the last one is co-authorization, another way to get into the back door, again, more risky, and it's not for everyone, is if you have a good friend, relative, somebody you know and trust, and they know and trust you, they can allow you to co-authorize on their card. And that card shows up on both of your credit reports. So if you have, and this is a twofer, here's a twofer. If your friend has an old card that they allow you to co-sign on it, you get an old card that's good on your report and one that gives you both points as you both use that card. They may have not even give you the card to use. They're keeping control of it, but it's on your report as an authorized user to that Visa card. Little tip, it's a great way to get your children into the game of authorizing them on your cards if they're over 18, but don't give them the card. You're basically keeping them from charging, but you're getting them credit points along the way. Well, it's a nice little side tip. Kids below 18 aren't supposed to have credit, nor are they supposed to have credit reports. And a little note too, I'm sorry to say, many parents put things in their children's name illegally. If they're under 18, they should have 0 on their credit report. I'm basically at the end here, unless you want to continue on another minute or two, Tracy, I'm done.
If anybody has questions and they want to stay on, that's absolutely fine with me.
Okay, well, I will go for a few more minutes. I have the time. If anyone wants to stay on with me, we have a what? How many people? We've got 16 people, 15 people? I'll stay on for a few more minutes. And so let me turn right now and ask, how about any questions then?
I have
Chat
one more.
or someone else. Deborah, do you want to go?
Yes. So if you got basically all your cards maxed out, like my thought was when I got my tax return to just go ahead and pay up my credit cards. Should I pay them slower than just going on and try to get them all caught up?
Well, there's a bunch of solutions for you, Deborah, or for anybody with lots of cards. There's a bunch of solutions, and this is where I would come back to, and I'm trying to be in full honest disclosure about my company. There's various ways for you to get fully out of credit card debt. One of them is you try to take out, I'm just giving you the options. One of them is you try and take out your own loan yourself. You go to a Citizens Bank, Bank of America, take out a loan, consolidate. So you take out $10,000, pay them all off, and then you pay one loan. So that's one method. The second method is you can go to someone like our company, and we are national. You can look us up, American Consumer, simply at consumercredit.com, and do what's called a debt management plan. And so you can call our number, and we're like other nonprofit services, call our number, tell them all about what you're facing, and then they can quote you. And I don't know, I don't want you to disclose how much debt you have, but let's just pretend somebody has $20,000 in credit card debt across 5 cards. That's all part of the conversation, and they're able to come back to you and quote, oh, you have $20,000 in cards. If you pay us $350 per month for the next 3.5 years, we will pay your creditors for you. They pass all savings to us, to you. So here's like a little known fact, which I find amazing. If you have a Visa card that has a 25% interest rate, as an example, but in our program, Visa charges no more than 10% to us. We pass that 10% savings to you that your card now only has a 10% interest rate. So there's a value in going through someone like a middleman like us who have been in the business for 32 years, and we are in the business of trying to eliminate credit card debt. That's the only way we make money. We're a nonprofit, but that's one of our only money makers because we get paid by the creditors. The creditors are paying us for the fact we're helping to facilitate payment to them. They like money, right? They love money. So we're helping them to get their money in an organized way through the people like yourselves. The other ways, there's things called credit repair, and I advise all folks to please steer clear of anything that says credit repair, because there's a whole different methodology. Look it up yourself. I advise you to. Anything I say, please look up. Credit repair is a different approach. It's when that middleman tells you, don't pay anything. Don't pay your creditors. Pay me instead. So money doesn't go to the creditor, and in a sense, the credit repair, in a sense, holds them hostage, saying, I know my client owes you $5,000, but I'm going to hold out until you lower that number. It's a less than good way of doing business, and they may finally acquiesce and say, yeah, we'll let them get away with $2,500. We'll only accept that. We'll be good. But here's the weird part. They not only take a piece of what you just saved, but now you owe taxes on the amount of debt you were just relieved of. So on the $2,500 that you no longer have to pay, you owe Uncle Sam money on $2,500 worth of debt removal. So you got to know what you're getting into on how you choose to eliminate your debt. Other questions, thoughts before I disappear into the sunset?
There are some in the chat. Is it possible to report rent payments to the bureaus?
It is possible, but generally they don't want it from you. The whole thing about rent payments that I mentioned earlier, I would suggest to the caller that you simply look it up yourself. There's all kinds of rent reporting companies. And it's another I mentioned before too, things like Experian Boost. What Experian Boost is Experian's venture into starting to be a good doobie, a good citizen, and start to report other non-credit things to the credit bureaus for you. But here's the catch again. Do you pay for that service or not? Some are free, some are not. What I've come to find out is that many credit unions don't want a stack of paper, don't want all this information presented at them. So therefore, they will often charge you for the ability to tell them, here's my 10 years worth of rent receipts. So bottom line is, it's not simple. But let me give you another tip, though, that is simpler. If any of you are in the market to buy a house, bring all those other receipts with you as part of convincing the mortgage lender that I've been a good citizen in my payments. In other words, another way of saying it is this: a credit score is not, you are not a credit score. A credit score is a piece of your life. It's a big piece, but it's only a piece. There's other parts of you that show your credit worthiness, your ability to pay rent, your management of money, even your bank statements, how you manage money. There's many other things in life to prove your credit worthiness, and you can do that on a face-to-face with somebody who you may want to borrow money from, like a mortgage lender, somebody for your condo, somebody you're trying to buy. The car dealers, I don't know, that may be a tougher sell. I generally don't like car dealers, but they're tougher to work with. But I don't know. Any other questions? I'll take one more.
Looks like, is it possible that Peter can display the few screens that he skipped over so we can read them?
I'm going to do this. This is what I am going to go to. I'm not going to go over that, but I am going to go over one last thing, something else I want to go over, and that's this, because I think this is more important. But you're going to get these screens. Remember, Tracy's going to sell them all to you so that you can have them all. All right. So the credit, here's the two things again, like the fork in the woods, right? The fork in the woods, it comes down and you have to decide one or the other. So here's one of those forks in the woods. You're all going to run your reports, right? You all remember how to do it, right? Annualcreditreport.com, so you see it. Your first question when you get your reports is this: is it accurate? So the first thing you're looking for is errors. So that's the first thinking. If there's a credit card on there that you don't recognize, that's an error. If you have a credit card that's been sold from Lowe's over to a collection agency, ABC Collection, you should not see both on your credit report. It's one or the other, right? You can't have both. That's an error. If you see a balance that you've never ever used this card before, that's an error. So part of your first mission is to look at your report and see what's true and what's not true. And you can fight errors by going to annualcreditreport.com. There's a place to dispute. So that's mission number one. The other fork is you have accurate things on there. So when it's accurate, don't come back and ask me, can I dispute it? No, we've already said these are accurate. These aren't disputable. You can't go back and say, oh, this isn't real. I already covered that on the pathway A. This is pathway B. They're accurate and they're old and they're sitting there. And if it's something like a charge off, it's something that you didn't pay back in 2018, that's a fact. There it is. You can't go back and push the creditor and say, I never paid. No, it's a fact. So the only thing you can do, and that's what this is trying to say, is you try to respectfully and professionally approach the creditor or the collection agency and say something like, this debt is from 2018 for $2,000. Now, here's why I didn't pay it. I'm sorry. This happened. I lost my job. My dog died, whatever. You say, whatever you have to say, but then you negotiate. You might be able to say to them, if you will remove it or lower it, I will pay you. I know it's for 2,000, but this debt is so old. Let me tell you a secret. They don't expect the money from you. If they get 500 out of the 2,000, they're happy. So you got to respectfully, intelligently negotiate with them and say, in a good way, I can't afford the 2,000 from that date, but if I give you 500, will you in writing say you will then remove that from the credit report? Now, as I said before, they have no legal responsibility to do so. If you pay it, they're supposed to reflect it. If I pay a $2,000 debt from 2018, it's supposed to go from 2,000 down to zero. That is supposed to happen. But the fact that it was a charged off debt doesn't go away. It stays there as a negative. Now, is it a big negative? No, it's something that happened 5 years ago. Like I said before, it's in the scheme of your 7-year period. It's smaller on the scale of importance. What's most important? What's occurred in the last 2 years is most important. Keep that alive and well. Keep those things paid. Make sure they're paid on time. Keep your debt low. But as you get older and older, 3, 5, 6 years old, what's going to happen in 7 years? Someone tell me, what happens after 7 years?
It falls off.
It falls off. Yeah. So time is a wonderful thing sometimes. I mean, it makes you older, but age has its privileges too. I get things now much cheaper because I'm over 60. Since I'm over 60, I get discounts and there's pluses, some pluses, not many, but there's some. I get on the bus cheaper. I go to Dunkin' Donuts. They give me like 20% off my coffee. I mean, there's great bennies of being an old guy now. Anything else from anyone?
I think we're good.
All right, well, then I have to go because I have an appointment. I have to leave and go to another appointment. But as I said, you guys can contact me via my email. I will make this available to Tracy, and I'm sure she'll have me back sometime to talk to all the savvy ladies.